Hey, I hope you're doing well. It's Jordan Dove here, Las Vegas Realtor. Hey, I came across some data that is pretty alarming. I think we might be on the verge of an international housing crisis. And I'm going to tell you why. I just received this data. It's alarming. It has to do with international real estate mortgages. So you're going to want to buckle your seatbelts up for this ride, okay? So for those of you that have been following me, you know I'm no nonsense. I'm going to give it to you straight. I don't feel the right thing to do is give you fluff and try to push my clients into doing something that isn't a good move for them. I do real estate by the numbers, and sometimes in this market, it does not make sense for my clients to buy or sell, and I've lost money giving that advice, but it was the right thing to do. For others, the numbers and decisions do make sense. Every individual's needs and situation is completely different. In every type of market, there are good deals and there are bad deals. So that's why I look at your current situation and analyze whether or not real estate is the right move for you at that point and give you my best opinion. Anyways, onto the meat and the sauce here, okay? Let's talk about the international housing market, and it's pretty freaking alarming. I've got to tell you, I did not know this information, and I had to make a video today and share it. I was like, I have to get this out there because I was like, holy shit, this could be really bad. So anyways, we all know that COVID caused a lot of things to slow down, but not for the global housing market. Consumers emerged from their lockdowns. They had a lot of savings and they were looking for bigger, better work from home places since you could, work from home and work remotely because you didn't have to go to the office. Now they want you back in the office. Anyways, you know that mortgage rates were at really low levels, and that helped fuel the home buying frenzy. Now with rising interest rates and red hot inflation, they have made homes and mortgages less affordable, which is increasing the risk of a crash in the global housing market, particularly in certain countries, and threatening to worsen a worldwide economic downturn. So what's happening right now in the housing market? Demand for housing is waning as mortgage rates increase. It's making homes less affordable and causing potential buyers to pull away from the market. That's the facts. That's what's happening. There are two main reasons why mortgages have become significantly less affordable this year. Number one, skyrocketing inflation has led to a sharp fall in people's real incomes. Secondly, central banks all over the world are raising interest rates at the fastest pace in decades. That directly increases mortgage rates, making it more expensive to borrow to buy a home. These issues impact not only would-be home buyers, but it's also impacting existing homeowners, especially those whose mortgages aren't locked in for the long run at ultra low rates, aka adjustable rate mortgages. I've talked about this a bit on a previous video about how we saw an uptick earlier this year in ARMs in the United States, but I didn't know what it was like internationally. So I dug into this, read this data, and I just had to share it. So during this COVID pandemic, millions of people borrowed cheaply to buy homes at record prices during this pandemic boom or scamdemic, whatever you want to call it. And many of them will suddenly face bigger monthly payments as their loans reset to reflect higher interest rates. Making matters worse is that those bigger mortgage payments have come at a time when people's real income, meaning how much money they earn adjusted for inflation, have plummeted. In the worst case scenarios, people will not be afford to pay monthly mortgage bills, won't be able to pay their utilities and gas with that skyrocketing as well. And in such a situation, banks would often repossess the house and sell it to recoup what's owed. In the United States, we call that a short sale or a foreclosure. And since that puts more homes on the market, often at a lower or what we call a distressed price, that can lead to further downward pressure on house prices. Mind you, housing markets, they vary a lot, and homeowners in some countries will be affected by interest rate changes more than others, depending on how exposed they are to rising rates. So, which countries are the most exposed? Let's talk about this. In the United States, most buyers rely on fixed rate home loans for as long as 30 years. The 30-year, fixed mortgage is what we are most accustomed to. Adjustable rate mortgages represented on average only 7% of loans in the past 5 years in the United States. By contrast, home buyers in some other countries more commonly have loans fixed for as little as 1 year or have variable rate mortgages that move in line with interest rates. Australia, Spain, and the United Kingdom and Canada had the highest concentration of variable rate mortgages as a share of new originations in 2020, according to Fitch Ratings. I'm going to say that again. Australia, Spain, the United Kingdom, and Canada had the highest concentration of variable rate mortgages as a share of new originations in 2020. This chart is absolutely stunningly crazy. Look at this chart from 2020 when rates were extremely low. These percentages are of variable rate mortgages as a percentage of all new 2020 loans. And the fixed rate will be expiring or resetting in the next 24 months for the majority of these loans. Over 90% of all Australian loans in 2020 were adjustable rates. 90%. That is absolutely insane. España, almost 60% of all mortgages are adjustable rates. The United Kingdom, almost 50%. Canada, almost 30%. The Netherlands, Germany, and Denmark, they're just south of 20%. The United States is about 7% for the past 5 years. Now, adjustable rates, they are used in commercial real estate world with balloon payments due in 5 or 7 years, and they're typically refinanced before the balance is due. Commercial, let me tell you, is in a world of trouble if these rates remain elevated. When they go to refi and their cash flow cannot cover these new monthly principal and interest payments, that's going to be really interesting in itself. But let's dig into some numbers in Australia. I did some digging here. On average, 500,000 dwellings are sold in Australia each year, or around 6% the total number of dwellings. This is on average, 500,000, 500,000 dwellings per year. In 2020, interest rates averaged around 4.5%, so I'm going to use that number as my baseline. At 4.5%, the inflation rate was 0.3%. Today, that inflation rate is 6.1% in Australia at the latest reading. And the last time inflation was that high was July 2001, where adjustable rates were, what do you think? 9.62%. Now, I don't have a calculator or an app for Australian mortgages and payments, but I'm going to use what I use here just to kind of get an understanding, a rough estimate of what that could mean for people in Australia or people in general who have these adjustable rates, who got a smoking deal a couple years ago, but in this inflationary environment, in this high rates where central banks across the entire globe are raising interest rates, it's going to have a huge impact if it doesn't stabilize, and I don't think it's going to stabilize. So anyways, looking at the numbers based on what we do here in the United States, I took a rough estimate of a 30-year fixed at 4.5%. A $350,000 home at 4.5% has an estimated monthly payment of principal, interest, taxes, and insurance of $2,221 with 5% down. So $350 at 4.5, $2,200 a month. Okay, 5% down. Now let's adjust that rate to 9.62 because that's what it was last time Australia had inflation like that. Okay, the payment jumps $1,140 to $3,361 per month. That's only on a $350,000 home, ladies and gentlemen. That is a huge increase of almost $1,200. That is a huge increase where for 1 year or 2 years or 3 years, you're making this payment, and now all of a sudden you're paying 50% more than what you were paying previously. What about your bills and your food, and you have a family, and that's going to get really tough. Now, it's not looking like good news because in 2020 alone, 500,000 people may be unable to afford their homes in Australia alone. I just found this astonishing. And I know the numbers will be different on how they calculate their mortgage payments, but I see that there's no way to really water this down. A substantial increase in monthly payments for the housing expenses, that's going to happen if rates and inflation stays where it is and keeps going up. Especially rates are going to keep going up. Inflation's high, they're going to raise rates, people spend less, prices come down, right? So anyways, it could get really rocky in Australia, not to mention the high amount of arms that were done in Spain, the United Kingdom, and Canada. Not to mention, home prices are now falling sharply across cities that saw some of the biggest gains, such as Sydney, Auckland, Stockholm, and Toronto. So how is this going to impact the global economy? Now, a globally synchronized housing market downturn, it would hit that market, that global economy, which is already teetering on the edge of a recession in a few ways. First, a sharp decline in housing prices would significantly reduce the wealth and lead to a drop in consumer spending. Secondly, a stagnation or slump in property construction and sales would directly hit global growth, since these activities are huge multipliers of economic activity around the world. Such as when you buy a new home, you got to get the furniture, you got to get the shades, you come get the landscaping, you get your new appliances. All that stuff gets shut down. And when that gets shut down, everything trickles down, right? Always happens in real estate first. Third, a declining property market would hit bank lending as the risk of bad loans increases, choking the flow of credit that economies thrive on. What's more is rising rates would add to pressures on properties developers who borrowed heavily to refinance their operation, leaving lenders increasingly concerned about developers' ability to refinance their debt. I just talked about that with the commercial stuff a few minutes ago. Again, if this leads to bad loans, it would hit bank lending hard. Fourth, as mortgage payments increase to reflect higher interest rates, people's discretionary income will take a hit, which would further dent consumer spending. So think about this, guys. I did not know there was that many adjustable rates out there on a global scale. 90% in Australia, 500,000 homes, 90% of those are on adjustable rates in a rising inflationary interest time we are in. It's just unbelievable. So anyways, if you guys like hearing about this type of information, go ahead and tap that like button. If you're new here and you found this information useful, please subscribe to my channel. I would greatly appreciate it. Share this video if you know anybody who lives in these countries, or if they could find this information useful. I just thought these numbers were staggering. I wanted to get it out there as soon as possible. If you're looking for a real estate agent, a realtor in Las Vegas, I'd love to help you. I also have an extensive network of real estate professionals in your area and would gladly get you a referral to them. I would let them do business with myself if I was in that area. I trust these people. So anyways, my contact information is in the description of this video if you need to get in contact with me. I'm Jordan Dove. Hope you guys take care and like this information on the international housing potential mortgage crisis. Have a good one.